Welcome back to the Financial Traders Hub. Stock markets in the US have been interesting to say the least. We've had a big sell-off in February and March, which was followed by a swift V-shaped type recovery, and now markets are nearing all-time highs. So as a trader, how are you supposed to manage with all this volatility and all this uncertainty? Well, the answer is exactly the same as always. Run a diversified long-short portfolio. I'm not going to go too much into details in terms of how you do that. This is beyond the scope. But what I'm going to present today is a short idea. So remember, when we're looking at these ideas, it's one idea as part of a portfolio of 10, 12 ideas, both on the long and short side. So without further ado, let's have a look at this trade idea that we've been presenting and discussing in our Discord server. The company we're looking at is ASANA. Before we do that, this is not financial advice. This is purely for educational basis. And also, all the material that's presented here is owned by the Financial Traders Hub. So, what does this company do? ASANA is a work management software. It's basically there to help companies manage their workflows and to a large extent unify silos within organization. We've all worked in corporate setups, so we know that when multiple teams have to collaborate, it can be quite difficult for them to share information and make sure that they keep track of project milestones and so on. So this is where Asana comes into play. So as of yesterday, the 19th of May 2025, Asana closed at $18.08 and it had a market cap of close to $4.3 billion. It was trading at a forward PE of 95 times, which I believe is quite elevated given the fundamentals of the stock. We'll get into that into more details later. So in terms of revenue expectations, the market is expecting it to generate a revenue growth of close to 7 to 8% next year, which hopefully will be increased to 11% for the next 2 years. So as you can see on the graph, the blue line is almost stalling now. And you know, when we look at such high PE stocks, that's obviously an area of concern for us. But we need to dig deeper and understand where these revenue growth expectations are coming from and whether the stock is actually likely to meet or beat or miss these expectations. In terms of earnings or EPS expectations, it's looking like it's going to turn a profit on the EPS basis, and that's going to be increased quite significantly in the future. So I think the forward PE that's been allocated to this stock is on the basis that 2027 and 2028 would be looking like relatively good years in terms of EPS. But that's quite further out, right? So now let's look at EPS on a GAAP basis. The reason we look at the EPS on a GAAP basis is because we want to understand what is the profitability of this company when you include stock-based compensation costs. So you can look at this in your own time. Basically, all the stock compensation that's been given to employees, whether that's sales staff, research and development staff, and management, are being counted as costs and expenses for the company, which I think is probably how it should be treated. But somehow, if you look at it on a non-GAAP basis, these costs are excluded. So this gives us a true idea of the profitability of the company. And as you can see, even until 2028, we're not going to be seeing a positive EPS on a GAAP basis. Sure, it's going to be improving quite significantly in terms of the expectations, but it's still not going to be positive. So, you know, once again, as an investor who's looking at this company from a fresh pair of eyes, paying 95 times forward earnings, and then the company is not expected to generate a positive EPS on a GAAP basis for the next 3 years, even if that gets smaller in terms of the loss. This is something that is not very attractive, especially when we look at the the fundamentals and also the macro picture at the moment, which we'll discuss in a minute. So in terms of the company's growth profile, let's just have a look where the revenue growth is coming from. They've been able to grow their customer base, which is fantastic. And if you look at the customer base that's spending over $100,000 per year, that's been growing at a 20% rate year over year. So quite interesting, right? However, if you look at the dollar-based net retention rate, that's not necessarily very exciting. Basically, what this is telling us is that customers are not actually increasing their spend with the company. They're more than likely to be spending less with the company. But this is a little bit problematic because it's showing us that the company is not able to capture an increasing size of their existing customer base wallets, right? So for a lot of software companies, you typically will see these numbers over 100%. Looking further, obviously they've had significant growth in 2025. However, this came at the expense of also having to increase sales and marketing as well as general and administrative costs. So revenue has increased, but operational costs have also increased quite significantly. So the company prides itself on having high gross margins. We're not debating that. Gross margins are around 90%. However, for the company to have true operating leverage, we need revenue growth to be much faster than what operational expenses are growing at, right? So the question we have to ask ourselves here, is the company able to scale efficiently? When we look at the management strategic plan, they obviously have an eye on the operating margins, right? So they pride themselves on having high gross margin, and they're implementing a number of measures to be able to improve operating margins. That's fantastic for the company, right? Because as an investor, you're looking for revenue growth, but also improvement in operating margins so you can capture a larger part of that top line growth in the bottom line, right? When we look at the macro setup, especially in terms of headwinds at the moment, we've got the US 10-year yield that's trading around 4.46 and potentially could rise from here with the prospects of inflation fueled by import tariffs rising. The Fed is also adopting a wait-and-see approach before making any interest rate cut commitments. So we're staring at a situation where we could be seeing higher rates for longer, and that can definitely put pressure on valuations of a lot of companies, especially those with high PEs, where the fundamentals are probably not warranting such high PEs, right? So what we possibly are looking at is for a lot of these companies that have high PEs to be re-rated downwards. The market now expects the first interest rate cut to only come in October 2025. That's still in 2025, but a couple of quarters away, right? And if you remember, as we came into January, expectations for rate cuts were much higher. So many more cuts with the terminal rate being much lower than where it is at the moment. At the same time, we've got GDP growth that could potentially be slowing down. So this is not positive for risk assets, especially those that depend on growth. In other words, high PE stocks. In terms of the company itself, I think it's got quite a few headwinds here. The company's revenue is still linked to a seat-based pricing model. It means that the revenue growth could be challenged, especially if we start seeing more layoffs within the US. At the same time, we're seeing business confidence waning. If business confidence is going lower, that's likely to lead to business spending crunch on discretionary software spend. Now, many might argue that a software like ASANA is not necessarily discretionary in nature, and that it is essential for many teams and organizations to be able to function. But, I would probably be on the other side of this argument. When things are tight economically, I think management take a totally different view of these situations, and they are more likely to delay such type of what I'd call not essential / discretionary spending. Also, the operating margins on a GAAP basis, in other words, inclusive of stock-based compensation, are not improving fast enough. We'll see that in the next slide. A slowdown in revenue growth will put even more pressure on the margins. We've also got a highly competitive environment. Let's look at one of the competitors, Monday.com, ticker symbol MNDY. I think it has a much better product, a superior growth profile, and also much better valuation with respect to the fundamentals of that company. We'll be able to have a clear look at that in the next few slides. In this slide, we can see the growth in their customer base. It's quite interesting to see the rate of growth of the customer base that's spending over 100,000 per year. If we look at the net dollar retention rate, well above 100% for all segments. So this is a company where the existing customers are spending more on the services of this company. So in other words, Monday.com is able to capture an increasing share of the existing customer base wallets. That's important to consider when we look at the growth profile of the company. Now moving on to the operating margin picture for Monday.com. As you can see, it's much better than what we've seen for ASANA. So in financial year 2024, that came in at negative 2% on a GAAP operating margin basis. That's been improving quite significantly. One could argue that even ASANA will probably see these types of operating margin improvements in the future. However, we are traders. We're looking at a much shorter time horizon of probably 4 to 8 weeks. At this point in time, I don't think we're going to see significant improvement in the operating margins. Now that we've seen that Monday.com has a superior growth profile as well as superior fundamental metrics, let's just take a look in terms of how it's valued versus its expectations of growth into the future. So revenue is expected to grow at 26% in 2025 and then 23% for the next 2 years. That's quite significant, right? On an EPS basis, the company is expected to grow 8.5% in 2025. So I think they probably will break even on an EPS GAAP basis in 2025. And then in 2026 and 2027, the growth rates are going to be much higher. So as we can see, Monday.com, which is a competitor of ASANA, has a much higher revenue growth level, but at the same time, on an earnings perspective, it's also going to be generating much higher growth. I would argue that Monday.com is much better in terms of its growth profile, its fundamental metrics, but at the same time, it has a much better valuation than ASANA. In terms of how we structure the trade, earnings are happening on the 3rd of June 2025. I've got a price target of $14 on ASANA. So in terms of the structure, buy puts on ASANA with a strike of $17.5 with an expiry on the 18th of July 2025. So as of yesterday, you could buy this for $1.6 and then you could sell puts against that position where the puts have a strike of 17.5 with a much earlier expiry, which happens to be before earnings. So if you sell puts strike 17.5 with an expiry on the 30th May 2025, you could get a credit of 35 cents per contract. So in total, you could put this trade on for, let's say, close to $1.25. And if you were to hit your price target, that probably gives you close to 280% in terms of your ROI. So obviously, there are different ways to structure this trade. The structure I've implemented in my portfolio is different from what I've got on the slide here. Morgan Stanley has also just downgraded ASANA, so it's trading much lower pre-market. Depending on where the stock will open today, you might not be able to get these same prices for the options. But you know, I think it's still a short opportunity. Guys, as you can see, we've been discussing ASANA as a short trade from the 24th of January. And then yesterday, I provided an update on the company and explained why I would put on this short trade position. And as you can see, the team is quite excited to be learning all of this. Of course, in the Discord server, we discuss things a little bit more in detail. As an example, I'm not really getting too much into the weeds in terms of how I eventually narrowed all these software companies down to ASANA and started looking into it and establishing whether it's a short trade or not. So all of this is discussed in the Discord server. I literally put down my thought process in front of the members in the Discord server. And it's all happening in real time. You either know how to do this or you're going to get found out, right? These things, you cannot randomly pick a stock and just write anything you want on it. There you have it, guys. So if you would like to join the Discord server, click on the link below. It's still free, but it's going to be behind a paywall from the 1st of June. So if you're interested to learn more about financial markets trading, this is the place to be. It's up to you to decide what you do with this information. At the end of the day, it's all about understanding how to do this properly on your own. How to generate the trade idea, how to structure the trade to manage the risk, and eventually how to keep doing this over and over again and be consistently profitable as a trader. So for those interested, I'll see you in the Discord server. For the others, good luck out there.